everyone out there. Sometimes there's a lot of people on here that phone in, so we don't actually see them up on the screen, but this is live teleconference anywhere. You can reach it with the computer. And we, every week, we try to have education, fellowship, deal-making, partnerships. We're not the typical talks to 200 people all doing their own thing. We rather like work together.
Right.
You know, trying to compete in the market out here with 1,000 different people, you got no chance.
Yeah.
You know, let's team up with 2 or 3 sharp guys, and you know, this is a lot of the A group comes here. So
good deal. So we're on the right spot then.
Yeah. So anyway, I would like to thank you, and I'd like to welcome Tom Rutkowski. Is that correct? Pronunciation, correct. Tom?
Correct.
Tom Rutkowski, I give you the background on him. I just saw him down in West Palm when I was down there. And fascinating, eye-opening experience for me. Michelle Moore's class about 4 weeks ago, about a week before, in fact, I think on the drive down to West Palm, I was listening to Michelle Moore, and she's talking to me about when you reach a certain goal, all right, don't just sit back now, change the goal, because you know, there's always an outside-the-box thing you didn't think of yet. Think of that 3rd dimension or 4th dimension. Well, you know, I always thought of borrowing off of your life insurance policy as a 2-dimensional thing. I borrow money, my own money back, pay myself back. Hey, that's a good deal. I make money there and I make money here. He brought a whole new dimension to the same thing. My thinking was wrong. And everybody I talked to had the same thinking, that you're borrowing off your own money, which you're not. You're borrowing off another person's money, and your money stays the same. I'll let Tom describe that to you. And right now, Tom Rutkowski.
Well, you set the stage really well.
All right, you're done now. I gave all your secrets away.
Yeah, so I started off hiding the fact of life insurance. So the title is Tax Advantage Real Estate Investing When You're Maxed Out Your Self-Directed IRA. So I like to think I'm picking up where others people leave off. I mean, the self-directed IRAs are a complicated strategy in and of their own right. And now we're picking up on what can you do when you've maxed out that contribution? How can you make money more effectively? So I know I only have like 20 minutes, so I'll just briefly tell you who I am. That's me, my little wife. We've got 2 little girls as well. Not little anymore, they're 18 and 21. I spent 8 years in the Marine Corps. When I got out of the service, I got a degree in economics from UC Irvine. I've also got an MBA in finance and investment from the University of Wisconsin-Milwaukee. I had a successful sales career and basically retired early about 5 years ago and came down here to South Florida. My goal at that time was to become a full-time real estate investor, but I realized pretty quickly that I could put my money to work passively in real estate, whether it be notes, tax liens, whatever, and earn really good rates of return, 15, 20%, very steadily, in what I consider a protected investment. And it made more sense for me, rather than trying to find deals and flip houses, to just get back into something that I'm good at, which is finance and investments. So I made a little move of getting into my own business. I still do real estate investing on the side, primarily tax liens, notes, and things like that are what I consider, again, protected positions, where you've got somebody else taking the equity risk, and I'm taking the debt risk. I'm the president of Innovative Retirement Strategies. That's my company. And I'm a financial blogger. So my target audience for this is basically anybody that really wants to accelerate the growth of their savings. I mean, what I'm going to show you is basically a way to not only invest your money and earn good rates of return safely in real estate, but whatever you can possibly invest your money in, you can earn a couple % greater by utilizing the strategy. And you just have to embrace it and understand that you're literally putting your money to work in two places at one time. So it's best suited for passive investors that are looking for a tax-advantaged alternative to a self-directed IRA. You max out the IRA with your $5,500 or whatever you can put into it, and now what do you do with the rest of your money? So this is the best way, and honestly, I'd argue that it's even better than doing a self-directed IRA. So I talked about the contribution limits. It could be limited by income on a self-directed IRA. You can't access the funds without penalty, and you have a very limited ability to use leverage inside of your IRA. And then a lot of people that have a lot of money in their IRAs, they started off with a 401k, and when they left their employer, they rolled it into a self-directed IRA. So Mark had mentioned earlier that it was life insurance as the underlying tool. So the concept of it is very, very simple. It's what if you could safely invest your money and make 6 to 8% average returns with no risk of loss? And what if you could use that money or that asset as collateral for a loan that you could take at a 4 to 5% loan rate? And honestly, right now, banks are loaning against cash value at prime, which is 4.25%. So what that means is you have an investment that's earning 6%, and then you've also got a loan equal to that amount, or some loss due to the life insurance aspect of it. But you can get this 4% money and put it into a 10% investment. So on the side, if you can make that 6% spread, and you're also earning 6 to 8% on the underlying asset itself, you're making about 12%, 13% on the same dollars of investments. So you're actually making more. And that's the beauty of what this strategy is all about. So I know people come into these meetings, or even when they're exposed to life insurance or on the blogs, and they think life insurance is a bad investment. And what I'm going to say is, it doesn't matter what you think about life insurance. I'm talking about permanent life insurance. This strategy works. It's all about building a high cash value policy design where you can turn around and leverage that cash value to make other investments with that leveraged money. So regardless of what you think about life insurance, this works. You can't shoot holes in it. I mean, the numbers speak for themselves. So I'll skip this slide. What does the investment need to look like? Usually I try to set the stage for what it needs to be. And there's no magic to this. I mean, you can do the same thing with a couple of other asset classes as well. Anybody that's doing a buy, rent, refinance type model is doing the same thing. You're putting your money into an asset class, and you're leveraging against it to put your money into something else. You can do the same thing with a brokerage account. There's lots of lenders out there that will loan against a brokerage account. It's just that the beautiful thing about life insurance is it's principal protected. And you can get a loan for virtually 100% or 90% at least of the cash value in a policy. And that's significant compared to real estate or securities. So I like to call this a magic checking account. So if you think of a checking account where when you write a check, it's drawn against the balance in your checking account. So the money is literally taken out and put into something. In the magic checking account, your balance stays there earning interest, and you have a credit line against that balance. So you're literally writing a check with borrowed money at the same time that your collateral, the cash, is still growing also. So the interest really cancels itself out. That's what I mean by a magic checking account. So these are some rates of return on permanent life insurance policies. I use index universal life and whole life for this. A lot of the infinite banking people, the bank on yourself people, I don't know if anybody's ever heard of those strategies. They preach that you can only use whole life insurance for this. And I'm here to tell you that any permanent life insurance policy will work for this. I mean, it's just a normal function of life insurance. In fact, it's written into the state statutes of all 50 states that insurance companies must make loans to their policyholders with the cash value securing those loans. So it's a no questions asked policy. And in fact, that's how most life insurance retirement plans are built. But anyway, index universal life, I've got some 5, 10, and 20-year rates of return here. In an index universal life, the interest that gets credited to the cash value is equal to the return on an underlying index, like the S&P 500. Usually there's a floor of zeros that you can't lose money, and a cap of that they set every year. It can be 12, 13%. On the whole life side, I've got 5.8 to 7.1. Mass Mutual was the top performing whole life. They've actually lowered their dividend rate now to 6.7%. But most companies you're going to find in the 5.8 to 6, Mass Mutual 6.7 is the tops. And those are not bad rates of return on something that people normally think of as a poor or bad investment. So at this point, I've kind of given you the magic of the strategy. You're putting your money into an asset class, and you're borrowing against it to invest in something else. So you're earning interest in two places, with the borrowed money and with the original asset. The thing is, at this point, most people don't understand whole life insurance or permanent insurance. So I always got to stop and explain what's going on. And I know you guys are all sitting around the table. Can I just see a hand of the people that really understand how permanent life insurance or whole life insurance works? No, yeah, a couple. All right. There's always a few that they're familiar with it. They think it's a bad investment, but they don't really understand how it works. So, term is easy to understand. Term is like car insurance. You get a 5-year policy, a 10-year policy, and the idea is hopefully you'll live. But if something happens, you pass away, the policy will pay a death benefit. But at the end of 5 years, the insurance company is banking on you not passing away, so that the coverage is going to expire. Permanent life insurance, on the other hand, will pay a death benefit. And when you think of life insurance as being expensive, it is expensive. But what you got to understand is that under the hood, the insurance company is doing two things with those dollars. I'll give you an example. A 40-year-old buying $1 million policy might only cost them $40 a month for that. For a 10-year term life insurance policy with $1 million death benefit. The same policy might cost $1,000 a month in an overfunded case for somebody buying a whole life policy. And you're thinking to yourself, why in the world would I pay $1,000 a month for something I can get for $40? Well, the difference is this will pay a death benefit someday. So in the background, what's going on is the insurance company is literally buying a 1-year term life insurance policy on you. That's probably costing them less than $40 a month because that was a 10-year term. And then they're taking the balance of it and putting it into a savings account for you. And the idea is that extra, the $960, that's you saving up your own death benefit. So over the course of your normal life expectancy, you putting in that $960 a month is basically going to grow and compound and become $1 million by the time you reach your natural life expectancy. So inside the policy, they're literally buying term and investing the difference for you. But the beautiful thing is that difference, the cash value, that money belongs to you. And it's written into all the state statutes of all 50 states that's your money. If you surrender the policy, you get that money back. But more importantly, the magic of this is the fact that the state statutes require that the insurance companies must make loans to you secured by that cash value. So if you think about it, it's really a way to get access to your money without paying the capital gains tax on the policy. If this were an investment, you'd have to sell it, realize the capital gain to gain access to it. But here, the insurance company, they know it's going to grow by 5, 6, 7% a year. So when they loan you their money at 5, 6, 7% a year, they know that it's growing by a corresponding amount, that their security or collateral is secure. So that's, to me, is what makes it so interesting. And when I was a brand new agent sitting in a room full of other brand new agents, learning how to, or getting walked through an illustration for a client with a life insurance retirement plan. What really struck me was I saw that by the time this client on the illustration had $1 million of cash value, the illustration was showing that they could get almost $100,000 a year of income off that policy. And having a background in the financial services business, I know that financial advisors use what's called the 4% rule. Typically, if you've got $1 million in a brokerage account, you shouldn't take more than 4% per year of that if you expect that money to last the rest of your lifetime. With the ups and downs of the market and inflation, if you take any more than 4%, you risk running out of capital someday. So here, this illustration was showing almost 10% in income to that client every year. So I thought, how can this be? Well, so I went home that night and I kind of looked at it and I realized what's going on is the fact that you're borrowing against it and not from it. And more importantly, the interest rate that you're borrowing is lower than the interest rate that it's earning at. Now, where can you get that? I mean, you can't. If you put your money in a bank, you're going to get 0.5% of interest. But if you want to borrow it, they're going to charge you 4 or 5. Here, they're paying you 7. They're taking your cash value. They're investing in all kinds of different assets: bonds, mortgages, a little bit in the stock market, real estate, and they're also loaning money to their policyholders because they know they're good for it. And if they can get 4, 5, 6% on that, they'll take it because they know the money's secure. So it's not a bad investment for the insurance company itself. But the magic is the fact that the collateral is still growing even while you're taking loans for income, and they're loaning you the interest it takes to pay the interest on the loans, means that you can take income at a much greater rate than what you can get out of a securities account. In fact, the way the numbers work out, it's 2 to 1. So me, being a real estate investor at that time, I thought to myself, well, holy crap, what if I don't want to wait till I retire? I mean, can I access this money early and use it to invest in real estate? And in fact, can I design a high cash value policy from the start that I can immediately leverage and use to put into real estate? And the answer to those questions was yes, you can. There's early cash value riders from a lot of different carriers that you can put on those policies, which grant you access to the cash value. What they do is basically eliminate the surrender charges so that you have full access to all the cash value of the policy. And the cash value can be fairly significant. So, anyway, I don't know, Tom. I heard permanent insurance is a bad investment. And I'll argue that anybody that says that really doesn't understand how insurance works. So just think about what you know about life insurance. It has cash value, it pays dividends, and most people know that you can at least borrow the cash value, even if they don't understand that you're borrowing against it. But Tom, my uncle had a policy that took years before it had any significant cash value. Well, a policy that's designed to be a magic checking account, one of these high cash value designs, is going to have about 85% of every premium dollar going right straight to the policy's cash value. So, if somebody had $500,000 that they were using for their real estate investing, I might design the policy so that they're paying premium over 5 years and $100,000 a year. And that policy is going to have about $85,000 of cash value, a line of credit for $85,000 that they can take on day one. So here's an example.
He's thinking about that. Say that again.
$500,000 to have a cash value.
So this is
$100,000 a year. $100,000 a year. So your first year, you put it in, you get 85. You can pull back 85,000 in a loan in the first year by putting in 100,000. Am I right there on time?
Yes. What's on screen right now?
It's pretty smart.
But you paid 15. See, this is where and we can get into this. And I'll just preface this by saying that I have some very smart friends who go both ways on this. And you're still paying $15,000 a year. That's going away.
You're not $1,000 a year.
Oh, okay. I don't understand that.
So there's three different fees that are in a life insurance policy. There's a premium charge that's only assessed on the premium, so that makes up 5.5% to 6% of the premium, but that's only in the years that you pay the premium. There's also a policy issue charge, and that's substantial. I mean, you'll pay about probably 9% of that is going to go to the premium charge, but that's only for the first 10 years. And then you have the actual annual cost of insurance. So in years 6 through 10 that aren't shown here, what you're going to see is that the premium charge is gone, but the policy issue charge will be there for 5 more years. And then after that, all there is the cost of insurance. And that cost of insurance, if you were to take it as a percentage of the cash value, is only about 0.25%. Now, here's the other thing I'll argue. You mentioned the fact that you're losing $15,000. You may be losing $15,000 on paper, and that's what it looks like to you. But that $89,000 of cash value can provide more income than $100,000 sitting in a brokerage account. Remember the 4% rule? If you had $1 million, you could take out 4% of that, or $40,000 a year for the rest of your life. $1 million of cash value can sustain over $80,000 a year because it's still growing even while you're borrowing against it. And that's the magic of this. You can get twice or even 3 times the income from the same amount of money. And I'll argue that what you're talking about is account statements. And at the end of the month, you get an account statement from your brokerage that shows that you've got 100,000 versus 80. But account statements don't pay bills. Income pays bills. You got to put food on the table with the money you take out of the account. So that $100,000 is only going to give you $4,000 a year, whereas $89,000 can give you, say, $8,000 a year. So it's a big difference. I wouldn't focus on the dollars that you think you're losing.
I guess I'm probably not alone I just don't have any basic understanding of this. As far as what exactly, in other words, if I put $100,000 into a whole life policy or an insurance policy that has a quote unquote high cash value, is that $100,000 I can borrow against it, and it's getting a dividend, and the dividend is tax free, but it's only tax free because it's growing, correct? In other words, you're not taking it.
No, it's tax-free because the way it's life insurance. So the only way you can access that cash value while you're alive is via a policy loan. And so the reason it's tax-free is because you're getting a loan.
Okay, so if I put the money in, I can't take
the beneficiary tax-free.
If I put the money in, I can't take the money out. I can only borrow against it. So it's an investment.
You can take it out.
I can take it out.
But if
you pay tax on it.
I would argue that you should never withdraw from a life insurance. When you can access a wash loan, why would you ever take it out?
Why take it out? He's saying leave it in, making the 7 or 8%, and use the money as a loan. Why would you take it out and lose the 8% when you can just do both?
Yeah. So you're getting paid a dividend on the entire premium that you've invested, correct?
You're getting a dividend earned on the cash value of the policy. So the more cash value you have, the greater the dividend.
The cash value. Okay. And then there are 3 fees: an issued charge, a premium charge, and the actual charge for the insurance. That's the cost that is taking away from what you put into it. Premium charge goes away after how many years?
The premium charge is only for years that you pay premium. The policy issue charge is only for the first 10 years in the policies that I write. There are some carriers out there that have 15 years. So keep one thing in mind. So life insurance itself is not the investment. So life insurance itself is not the investment. I mean, we can argue whether or not life insurance is a good investment compared to real estate. No, real estate's better. I mean, it's this. All we're doing with this is putting our money into an asset class that's going to grow at 7% versus 8%. And we're borrowing against it to get access to the same dollars to put into real estate that we can make 10% of. So this $85,000 is going to earn, let's just say 7% interest. But if I have a credit for $85,000,
we don't have to make killings all the time. Just if we can get an extra percent here and an extra percent there. A guy in Florida does car dealerships, and he ships his money through Canada and just picks up 1% on the exchange rate. That's a smart. If you know how to do that kind of stuff, then just grab an extra percent anywhere you can. It's interesting.
So the brokerage I have though in Northwestern, I have a cash value life insurance policy with them, and the way he describes it though, he said, I mean, he's kind of describes it like your deal doing money. And he recommends, like, if you need it to, like, say if I'm doing rehab and I needed a strap of cash, that you can take money out of that without, get with tax-free or whatnot, and then just put it back in the policy. It doesn't affect anything with the policy and use that as your deal doing money. Now, you're saying you should not take the money out of that. You should just borrow against, like you said.
Well, remember, there's cash in your policy. You can borrow against the policy, or you can physically take a withdrawal. And I'll tell you this, any agent who uses the language like you just said, where you take the money out of your policy, doesn't understand how their policy works. You don't take money out of the policy. A policy loan is a loan from the insurance company, their money, with your money as collateral. So your cash is never, ever, ever coming out of that policy unless you literally take a withdrawal, and that'll lower your death benefit. Or cancel the policy if you take out too much.
The way he described it is like, if I take it out for a limited time though and then put it back in, like, I don't know what the time frame is, it doesn't affect anything with the policy. Like, it won't lower that death benefit. It won't change anything. But then you just said it would lower, like you just said it would change it though.
Withdrawal.
To where you're not planning on putting it back in, is that what you're saying?
Correct.
Okay.
No, too many life insurance agents use the language of take the money out when they really mean policy loans. And I'm just being technically correct on that. Any policy loan is the cash value.
Can you explain the reason why you wouldn't have the person invest the entire $500,000 up front, or are there limitations on what you can convert into cash value?
I asked that too.
That's a really good question. The premium drives the death benefit, and the death benefit is is the load on this. It's the cost. So if I put 500, well, I didn't say what the death benefit on this was in this policy. It's in the notes below it. This particular policy had a $2.2 million death benefit for that 45-year-old. If I put $500,000 in one time, I would basically create a policy with that had to have a $11 million death benefit, 5 times the 2.2. So the premium drives the death benefit.
You can't put more in. You got to put a set amount in that to equal. If you put more in, you're going to raise what you have to finally buy, right?
Exactly.
So it raises the
premium that's 5 times the death benefit. And the problem is, here, I'm getting the $500,000 to work very quickly in 5 years. If I put $500,000 in and I had an $11 million death benefit, now I've got the cost of that $11 million death benefit sucking up this cash every year. So it's just not going to grow the way it is here. Here, I'm trying to minimize the death benefit so that I'm maximizing the cash value. I'm just staying compliant with the IRS formulas that govern this. Does that make sense? Does that answer the question?
Yeah, it's still fuzzy for me, but it's all going to come together eventually.
Yeah, that's what I asked them. Can I just throw the whole $500,000 into the account, pay off one time, then start borrowing it back? well, no, because I can't buy a $2 million policy. I'll have to buy the $20 million policy or the $10 million policy, which is going to cost more fees.
You got to remember that. The insurance company is literally buying a 1-year term policy on this person for $2.2 million every year. So if you had a 1-year policy was actually for $11 million, it's going to cost 5 times as much. So, the cash value is going to earn the same dividend. It's just that you got 5 times the load on it. So that's why you structuring this over 5 years.
Hold on, Tom. Larry has a question.
Hi, Tom. At the end of year 1, how much can you borrow from this policy?
On day one, you borrow about $85,000. So this cash value is $89,000. That's in the illustration. That's actually the end of your cash value. So there's growth already imputed in that number. But the starting cash value, after all the fees and everything else was taken out, was probably $85,000-ish.
And then you're up to 510 at the end of 5 years.
Right.
Is that right? 510, 412.
Yeah.
Okay, so 9,000 you have listed includes the dividend but takes away the fees.
Right.
Yeah. So $100,000 less the premium charge, the policy issue charge, and the cost of insurance, and then plus the 1 year worth of growth on it.
Can you buy more than one policy? These guys want to buy.
I'm just asking.
These guys want to buy 5 life insurance policies.
I'm just thinking.
Now, can you buy more than one policy?
Of course you could, yeah.
Of course.
I guess you can. Right?
The key is life insurance, and we have to justify the death benefit. I mean, if you're a greeter at Walmart, you can't justify a $2 million death benefit life insurance policy.
Let's give everybody in this room
what if you're a really good greeter?
All right, Tom. Hey, listen, this is good stuff, Tom. This is good stuff.
So actually, Roy he's
the
bringing
key
up
here
a
is
point
keeping in
here.
mind that the life insurance is not the investments. This is just a place to put your cash and keep it working while you're doing life.
But Roy, he's bringing up a point that I think is actually kind of interesting. There are probably a couple of people in here that could do $2 or $3 million in something like this, and so that might be in other words, if they active real estate investors who are using their own cash to buy properties, and so why wouldn't you do 4 or 5 if it's the way to do it? If you're an active real estate investor and you're using your own cash, why wouldn't you do it 4 or 5 times? I'm very new to this. I'm bouncing.
Well, you could buy a bigger policy instead of buying 5 policies.
Well, no, you said you didn't want to do
It's
that.
going to be the same net problem.
It's the same problem.
You buy five $2 million policies, it's going to be the same as $10 million.
It's the same.
Your premiums are going to eat you alive.
So let's go back to this again. I used $100,000 in this example because the assumption was that this person had $500,000 that they were using for their real estate investing. And I was just putting $100,000 a year into the policy to get it in as quickly as possible and minimize the cost of insurance. The scale or the proportions will stay the same in any policy. The only thing that ever changes is the death benefit. So you can take a look at this and you can add a 0 to that. You can take a 0 off. You can double it. You can have it. The death benefit and the cash value are almost always going to be proportional to the amount of premium that you have. So don't take the $100,000 and use that as, that's the policy. This is just an example. So
I had $2 million to invest. If someone had $2 million to invest, you'd have them put in $400,000 a year.
Exactly.
Okay. So you wouldn't have them do it 4 times. You'd have them put in $400,000 a year for 5 years.
Exactly.
What about buying something like this for the grandkids? How can you benefit out of it?
So back up a little bit. There's always 3 life insurance contracts. There's the policy owner, the insured, and the beneficiary. So you, the insured, can have a policy on your grandkids, but the key there is the younger you are, the more death benefit you can get. You know, like I said, these ratios always stay constant. The only difference between an 18-year-old and a 45-year-old is going to be the death benefit. Because the 18-year-old has so many more years of life expectancy, their death benefit might be $4 or $5 million on a policy. But the cash values are going to look exactly like this. Does that make sense?
Borrow against it. Can we borrow against it?
Absolutely. I was just trying to make sure you understood this point. So the issue is how do we justify a $10 million death benefit on the grandkids? And so the way the insurance companies look at it is the parents have to have at least as much coverage as the kids do. So now you're running into, it'd be nice to put a $10 million policy on your grandkids and overfund it like this. But the insurance companies have their own internal underwriting rules. So you can't put a policy on your kids for $10 million when you only have $50,000 on yourself. You have to have the same amount of coverage as your kids. And if you have multiple children, you have to insure each one the same. And they do this for a reason.
And so I guess one thing you would say, one of the primary advantages as opposed to a brokerage account, if you're trying to leverage a brokerage account, you could have a margin call, and you would never have a margin call with this.
Exactly. Well, the risk of a brokerage account is that you can lose money. So the lenders, they're only going to give you maybe 50% loan to value. The more secure your asset is, the securities, the more they'll loan you. But life insurance is more protected, and you're likely to get, from the life insurance company, you can cash value.
How fast can you get your money? If I call them today, when do I get the money?
I usually tell my clients to wait at least a week after they mail in their premium. Give them a chance to cash the check and put it in the bank.
Like as soon as I get it, if I have
a deal,
if I had it in there for a year and I wanted to get $80,000 out, is there a big long process? Is it on demand? Do we do a credit check? What's the procedure, and how fast can I get the money?
It's probably not going to be as fast as you'd like, but it's pretty quick. I mean, you literally fax them a policy, a request for the policy loan, or get them on the phone, and they'll mail you a check. I mean, that's you can get them to wire it to you, but the default is to have them mail it.
Credit check. There's no.
No, there's no credit check. So let's kind of skip ahead. I have this one slide on policy loans. So the key I want to drive home here is the policy loan is only one way to access the cash value. And again, I'll just drive home the point. This is the biggest misconception people, including many life insurance, have about policy loans. You're not borrowing from your cash value, you're borrowing against it. And some people just don't understand that distinction. But your cash value never leaves the policy. It's always there, and it's always earning interest. But, we've got more slides there, I forgot. Bank loans are the preferred way to access the cash value. So, when you're doing investing this way, you want the tax advantage. And policy loan interest is not tax deductible like mortgage loan interest is, or commercial loans. When you're doing a real estate deal and you borrow money from the bank, that's an expense that goes on your profit and loss calculation. Whatever you pay for the policy, less the loan interest you have. Now you get back to your profits. So the same thing is true with when you're doing a policy loan. You want that interest to be tax deductible. And the only way that I know that you can do that is to get a cash value line of credit from your business. And the bank's going to want a guarantee, right? A personal guarantee. And that's where you give them an assignment of collateral against your life insurance policy. So you're not putting money into your corporation. You're not putting a life insurance policy on you for the corporation. You're just giving the bank an assignment of collateral which gives them first dibs on your policy for the amount of the loan. But now your business has a corporate or a commercial loan. And now that interest is tax deductible. So let me just give you an example of why that's important. Maybe it's not immediately apparent. If you have $100,000 and you put it into an investment with a 10% rate of return, you're going to make $10,000 that year, right? And if you're at a 28% tax bracket, you're going to pay $2,800 in taxes. If you borrowed money from a policy at 5% and you made that 10%, you're still going to pay tax on 10% income. So you're going to lose $2,800 to the tax man. Then you've got to pay the $5,000 back to the insurance company. So you're going to be left with the $2,200 difference. That's your profit on that deal after closing everything out. If the interest is tax deductible, you made that 10% return. Now you got $10,000 minus the $5,000 of interest expense. Now you're going to get taxed on $5,000. What's 28% of 5,000? I don't have a calculator. But anyway, you realize it's a much bigger number than $2,200 because the interest is deductible and you're lowering your taxable income. So there's two things going on here. I mean, if my cash value is making 7% and I got a cash value line of credit at prime 4.25, I've got an arbitrage between what my savings is making and access to the money on it. More importantly, if that interest is tax deductible, I've got a tax advantage because I'm lowering the taxable income on the investment I'm making. Is that clear?
And being that it's all cash, if you're taking an equity line off a $100,000 piece of property, the bank's going to want to cushion their fall, so they're going to give you 50% loan to value. By being cash value, they could give you all 100% of the value of that property when you ask.
That's a good point. So there's a case where you would want to use a policy loan because policy loans don't show up on your credit report. So if you're going out to get a loan for property and they're looking at your debt to income ratio and they see that you've got other loans, they might want you to make a 20% down payment, right? Or 30% or 35%. But if you use the policy loan to come up with that 35%, the insurance company's money, now you're in that deal with all borrowed money. You got the bank's money for 65% of it, and you got the insurance company's money for the other 35%.
Larry and I were talking about today when Larry was doing his mortgage class about PMI insurance. You want 20% down. You can go get a policy loan for the whole 20%, and it's from you, so you can pay your 20% down payment, get your 80% from the bank, no PMI insurance, which is I don't know how many percent that is, but nicks off another couple $100 a month on your PMI insurance, and you pay back 4%.
Yeah, well, in this case here, I mean, it's an opportunity to get an infinite rate of return. Because your cash is in the life insurance policy earning interest. And you're doing your real estate deal with 100% leveraged money. That's an infinite ROI. So the downside is to get the bank loan, you do have to have credit. Although when they have collateral this good, as long as you can fog a mirror, you usually can get a loan. There is an application process, and you do have to make payments. So, I mean, that's the upside of a policy loan. In a policy loan, they'll actually, if you don't make an interest payment, they'll basically force you the money it takes to pay themselves the interest, and they'll just tack it onto the bill that you owe. So they'll collateralize the interest as well. But you can get by without making payments. So that can help, depending on
how long can you take a loan?
Well, remember, the typical use for this is the life insurance retirement plan. I'm in that fraction of 1% of life insurance agents that are doing something like this. The vast majority of people that are using life insurance for retirement plans are building retirement plans based on this model, once you reach age 65 and you've got all this cash value built up in the policy, the idea is that you're going to start taking loans for retirement income, and you don't pay those loans back ever. You might get a $100,000 a year loan from the insurance company, and each year, if the policy grew by 5% and your loan interest rate was 5%, they're literally loaning you the money it takes to pay the interest and tacking it onto your bill. Does that make sense? So you'll never get behind because your cash value will always equal the amount that you owe. And then someday when you die, the death benefit pays off the loans, and then your beneficiaries get whatever's left over. So that's the way life insurance is typically used in a retirement plan. So these loans, you don't have to make payments on them, and you don't have to pay them off. I mean, if you die, the death benefit will pay off. Is that clear?
Yeah, that was good.
I mean,
If someone comes into some more cash and they want to increase the amount that they have in their invested in their whole life policy, do you amend the policy? Do you start a new policy? How does that work?
It's easier with a universal life insurance policy because it's universal. A whole life doesn't give you a lot of flexibility to make changes like that. Once you set it, you're in it. You'd have to open up a second policy if you wanted to start contributing more. To your point, these policies are maxed out. I mean, you literally can't put another dollar premium into them without creating what's called a net modified endowment contract. So we try to. I fund them right up to that limit, but not over. I forgot. I'm trying. Lost my train of thought on your question. What was the question again?
Well, it's just if you come across more money that you
more money. Okay. More money. So on a universal life insurance policy, yes, you can make the change and increase the death benefit. So to do that, you're basically gonna have to go through underwriting again. So let's just say your death benefit, you come up with enough money, and your death benefit would change from $1 million to $1.5 million. The insurance company just wants to make sure that you didn't find out you had cancer and now you're raising your death benefit or asking for an increase. So you have to go back through underwriting. But basically, that extra tier of $500,000 of death benefit is basically going to go through the same fee structure again. It'll be like a second policy layered right on top of the first. Does that make sense?
All right, Tom. Let's sort of stop there because everybody's brains are like going out there. You can take some questions, but don't finish. Tom is going to do a full class for us one of these days, right, Tom?
We already have a date.
Yes.
We already have a date for that. It's actually on the calendar. On the calendar,
and we're going to have him back for a full.
It's August the 8th. August the 8th. It's on the calendar. Right. It's on the calendar.
Is that's for green members, right?
Correct.
Okay.
Yeah. So Tom's going to finish. Of course, you can always call him up, Tom. Give him your pitch, where you are and who you are and how to get a hold of you.
Well, the information was on my very first slide.
You can go all the way back like this. There you go.
Oh, hey, look at that. So I'm simply Tom at innovative-retirement-strategies.com. That's my website as well. And 561-676-8982.
And if you sail, it's even better. Any questions for Tom? Tom, they're all stunned. About midnight tonight, all of a sudden they're going to have questions, but I'm sure they'll call you if they need you.
Well, the main point here is, regardless of what you think of life insurance, when you have your money working in two places like that, you're going to make more money. It's just going to be a marginal.
Let me explain. Three people came in after you started. They might look at this as some kind of life insurance pitch. The reason Tom came here today is not to really pitch life insurance for life insurance. Now you're saying, what is this, a life insurance thing? is how to use your life insurance benefits or your cash value to buy more real estate. That was the premise of this talk. And you guys, you sort of missed the beginning of it.
Yeah,
you did. You saw it, but I mean, these three here. It sounds like it's a life insurance pitch, but it's.
I don't. We'll do the questions later. I've got.
Tom,
yeah, I need to read more, but I've got a lot more questions. So.
Excellent job.
Well, I've got
Thank you very much. Thank you.